Before we start, remember, this video is for educational purposes. Trading options involves significant risk and isn't for everyone. Protect your capital. Stop chasing the market. Today, we're mastering the two simplest high-probability entries for both calls and puts. Let's get to work. Think of a call as a bet that a stock's price will go up. To win, we need to buy at the right moment. Our first setup is finding the floor, or support. This is where buyers historically step in to stop a price from falling further. When price touches this floor and starts to bounce back up, that's your signal to enter a call option. It's low risk because the floor is right beneath you. Look at this example. Every time price hits this level, it bounces. We wait for that green confirmation candle before buying our call. Our second call setup follows the trend. We use a moving average line to show us the general direction of the stock. Think of the moving average as a sliding floor. In a strong uptrend, price will often pull back to this line before continuing higher. When price touches this line during an uptrend, it's like a spring loading up. This is a high probability spot for a call entry. So for calls, either buy the bounce off a horizontal floor or the touch of a moving average during an uptrend. Simple. Now, let's look at puts. A put is a bet that a stock's price will fall. We want to enter when the price is hitting a ceiling. The ceiling, or resistance, is where sellers step in. Price struggles to get above this level, making it a great spot for puts. When price hits the ceiling and starts to drop, that's your signal. Your risk is low because you know exactly where the ceiling is. See how it hits that red line and fails? That rejection is your cue to buy a put option. We expect price to fall back toward the floor. Just like calls, we can use the moving average for puts too. In a downtrend, this line acts as a moving ceiling. Every time the stock tries to rally but hits this moving average and stops, that's a bearish signal. It means the trend is still down. Notice the touch and the immediate drop. This is your high probability entry for a put trade. You're trading with the trend. For puts, watch for rejection at a horizontal ceiling or a touch of the moving average during a downtrend. Keep it simple. There's one secret ingredient to all these entries: volume. Think of volume as the fuel for the move. If you see a bounce off support with high volume, it's much more likely to succeed. High volume means big players are involved. Even the best setups fail sometimes. That's why we always use a stop loss. It's your safety net. A good rule of thumb: never risk more than 1 or 2% of your account on a single trade. This keeps you in the game. The hardest part of trading isn't finding the setup, it's waiting for it. Don't chase the market. Let the trade come to you. Before every entry, run through your mental checklist. If it doesn't check all the boxes, walk away. There will always be another trade. Successful trading isn't about one big win. It's about doing these simple things over and over again with discipline. Review your trades at the end of every week. Learn what worked and what didn't. This is how you grow as a trader. Always check the big picture. It's much easier to trade when you're swimming with the current of the overall market. Watch out for big news events like earnings. These can break even the most perfect technical setup in seconds. Discipline is the difference between a gambler and a professional. Stick to these simple entries and your risk rules. One last time. For calls, we look for the bounce at the floor or the touch of the upward trend line. For puts, we look for the rejection at the ceiling or the touch of the downward trend line, confirming with volume. Options trading doesn't have to be complicated. Master these simple setups and focus on your discipline. You've got this. I hope you enjoyed the video. Please do not forget to subscribe to my channel.